when disco was king and hair was, well, let's say unusual. Dr. Bessembinder was here soaking in Aggie life. Unlike today, he wasn't at the center of the academic profession back then, but he was in the middle of something even more important to many students at the time. He used to work at something called the high-rise cafeteria, now called the Junction. A number of presidents, hairstyles, and several recessions have come and gone since Dr. Bessembinder graduated from the Huntsman School of Business. But through it all, he's been making us proud. Dr. Bessembinder, as I mentioned, is now the Blaine Huntsman Chaired Presidential Professor at the Eccles School of Business at the University of Utah, and is a very prestigious professor of finance. Has been recognized as one of the most prolific authors in the top 7 finance journals over the last 50 years, and has served as managing editor or associate editor for 3 of the 4 top journals in the field. Some of Dr. Bessembinder's research has focused on the way stocks are traded, and that has led to a more precise way for valuing stocks. Prior to 2000, stocks were typically traded in multiples of an 1/8 or a 16th, and I'm sure all you students know about that, right? You were back trading stocks as 1/8 or 16ths in those days. Today they're traded in the penny, and that has, research has shown that that has led to much more efficient trading as a result. The list of companies and organizations that Dr. Bessembinder has worked with is impressive. And even though he's not ever marketed actively his services as a consultant, he's been engaged by some of the most prestigious and major corporations and government entities in the country, including Goldman Sachs, the New York Stock Exchange, the United States Department of Justice, United States Securities and Exchange Commission, the Attorney General for the state of New York. We've brought some impressive people here to serve as convocation speakers and as Huntsman visiting professors. None more impressive than Hank Bessembinder. Welcome.
Thank you. Well, thanks for that very kind introduction, and I want to say I've really enjoyed my year here as a visiting professor. It's been nice to my roots here where I grew up and where I was an undergraduate some decades ago. As Doug mentioned, I've spent a fair amount of time on my research endeavors over the years, but of course our teaching mission is a crucial part of our role as academics as well. And I wanted to spend a little time today just kind of talking about some of the philosophy of what we teach in financial management courses. And for some of you, this will be kind of revisiting issues that you've thought about. For others, it may be some new issues. It's kind of my perspective on these issues, and my perspective might differ a little from some others, in part because I've had some experience working as a consultant with government agencies as they've investigated various types of wrongdoing in the financial markets, and so that's given me some additional perspective. So I titled the talk "Financial Management to What End?" I teach courses in financial management and in financial markets, as do some of you, and then many of you are students in courses in financial management, financial markets. But to what objective is the financial management, financial markets? So I listed here a few possible objectives for financial management, objectives that have been promoted by at least some parties at some times, maximizing profits, ensuring that the organization survives, maximizing resources that are available to the managers, providing stable employment, being a good corporate citizen, focus on share price, focus on shareholder value. Most finance textbooks take a fairly specific stand on what the objective should be of financial management. So I pulled a couple of quotations, first from Ross Westerfield and Jaffe's text, Corporate Finance, 9th edition. This happens to be the book that I teach out of regularly myself. So Ross Westerfield and Jaffe say the goal of financial management is to maximize the current value per share of the existing stock. Pick up a second quotation. This is from another textbook that's been around for a long time, widely used. Eugene Brigham and his current set of co-authors, Gabensky and Earnhardt, Financial Management in its 9th edition. Management's primary goal is stockholder wealth maximization, which translates into maximizing the price of the firm's common stock. I'm not entirely sure if these two authors conscientiously chose the different words value versus price, which is a point I want to come back to in a minute. But in any case, it's quite clear that these prescriptions, which are pretty representative of what's in finance textbooks, say that the goal of the company should be focused on the shareholder and enriching the shareholder. How many of you are familiar with the name Gordon Gecko? From the recent follow-up of Wall Street or the original Wall Street? Because if you have to choose between the two movies, the original Wall Street's a much better movie than the recent follow-up. So Gordon Gecko, you'll recall, is a character in the movies Wall Street, and Gordon Gecko was a corporate raider. He was in the business of taking over companies, hostile takeovers, and then taking them apart. He was definitely a villain, as envisioned by Oliver Stone, the director of the original Wall Street. And of course, in the original Wall Street, Gordon Gecko uttered the famous phrase, "Greed is good." So are our textbook authors, are they just echoing Gordon Gecko? Or is there something more to it? If they are echoing Gordon Gecko, where have they been the last 10 years? Didn't they notice there was a few bumps in the road called Enron and WorldCom and the financial crisis of the last 4 years? So what I'd like to do is shine the spotlight on what are the underlying assumptions. The people who write these textbooks are actually pretty learned and pretty thoughtful people. And when they make these recommendations, it's based on some implicit assumptions, or maybe explicit assumptions. And I'd like to shine the spotlight a little bit on those assumptions and talk about to what extent do we think those assumptions are reasonable or not reasonable. As we go through this discussion, and there's no question that there's been some bumps in the road in recent years with episodes like Enron and the financial crisis and the Great Recession of the last few years. I think it is worth keeping in mind some data and some evidence on how well the system has worked. So what I pulled up here is just data on GDP, gross domestic product per capita. And that's certainly not a perfect measure of how well an economy is working, and in particular it doesn't take into account cross-sectional variation, inequality, but it tells us quite a bit. So this is GDP per capita adjusted for inflation. It's in 2005 dollars. The blue line's the United States. First thing I want to point to is how much that's risen over the decades. So right about here, I'm graduating high school and entering the College of Business at Utah State University during our recession of 74, 75. And GDP per capita at the time was right around 23,000. By the mid 2000s, we're up to almost 45,000 GDP per capita. And then we have the Great Recession, which, as has been pointed out, is the worst recession since the Depression. True. But notice the drop in GDP per capita is nowhere near where we were 20 or 30 years ago. So let's keep that in mind. Also, the red line is the developed world excluding the U.S. There are some countries out there that have higher GDP per capita than us, but on average we're ahead of the rest of the developed world. And down here, we have the former centrally planned economies. such as China and Eastern Europe. Of course, China gets lots of press these days. You see headlines about China's going to overtake us at some point. Keep in mind the population is about four times as large also. GDP per capita in the former developed countries is way down here. Something to keep in mind if you hear people saying that the solution to our recent problems is a wholesale move towards central planning. But there's no question that there have been problems, fairly serious problems. So I'll just touch on a few of them here. So Enron, there was accounting fraud, there was market manipulation. The CEO got 24 years in prison. WorldCom, accounting fraud. The CEO got 25 years in prison. Tyco, theft, for lack of a better word, by the CEO, 8 1/3 years in prison. Then more recently, the mortgage credit rating financial system meltdown of the last 4 years. So certainly the system has not been working perfectly. So what I'd like to do first is revisit the classical arguments in favor of profit and value maximization as a goal, and then hit some of the places where I think that, in fact, breaks down and falls short of full potential. But any discussion that revisits arguments in favor of free enterprise has to start with Adam Smith and his phrase, the invisible hand. So some of you are quite familiar with Adam Smith's arguments, but if not, let's bring you up to date or refresh your memory. The key part of understanding what Adam Smith had to say is to recognize the role of prices in a market economy. So prices tell us about values. A particular use of the word value as in willingness to pay. Prices reveal how much society values a good or service in terms of willingness to pay. Now, that doesn't necessarily mean that all of us value something. I mean, we're not all alike. But if something commands a reasonable price in the marketplace, it says somebody in society values it. And we aggregate across all the people, it's valued by society. Prices reveal how much society values goods and services. Again, not necessarily your valuation or mine, but society's valuation. So take that in mind when you think about implementing the sort of tools that are taught in a corporate finance course. So we focus on net present value. There's a proposal. Go into a particular product line. You work on your best possible assumptions about how much you can sell, what price you'll be able to sell for, how much it's going to cost you for the various inputs, how much you'll have to pay the labor involved, how much you'll pay for raw material. You work on your best assumptions. If based on your best assumptions, the present value of your revenues exceeds the present value of your costs, it says, based on your best assumptions, society values what you're going to produce more than it values what you're going to use to produce it. That's what a positive NPV tells us. The flip side is also true. If a particular product line is no longer profitable, if your analysis says that shutting down this factory would be a positive NPV decision, what that's saying is society does not value what you're producing as highly as it values the costs of what you're using to produce it. Now that can't be good news if you're one of the people working in that line of business, being told society doesn't value what you're producing here as highly as what we have to pay you. That can't be good news for you as an individual. Nevertheless, it's the efficient thing to do. Now, hypothetically speaking, if someone was running for president and that someone had in their own employment history a history of working in private equity and, among other things, closing down businesses occasionally, I can understand why it's really hard to put this in a soundbite, but I don't think you can really get away with entirely avoiding a discussion of the topic because it is economically efficient. Just a quote from Smith that you've probably seen before. It's not from the benevolence of those who are providing for us. It's because they pursue profits. If they pursue profits, they provide us with what we value. Another argument in favor of pursuit of value is really self-interest. So again, Gordon Gecko. Gordon Gecko's character in the movie Wall Street. So he was played by, who knows who played Gordon Gecko? Michael Douglas. So he's played by Michael Douglas. This is an Oliver Stone movie. Oliver Stone movies always have an anti-establishment bent to them, right? So that's the background. But this guy's a villain. Okay? Oliver Stone knows it. Michael Douglas knows it. This guy's a villain. All right. So a few years ago, I'm riding on an airline. I can't remember. I think it was Delta. I'm not sure. I pick up the airline magazine, and there's an interview with Michael Douglas. And he touches on various topics. But one of the things that he touches on is that he had played the role of Gordon Gecko in this movie, and he's a villain. He's a bad guy. Nevertheless, he occasionally gets letters from people saying, "You inspired me." And he just can't understand this. Well, he doesn't understand Adam Smith's logic, that sometimes it is, in fact, good for society to shut down a business. All right. But anyway, Gordon Gecko is in the business of hostile takeovers. But how do the Gordon Geckos of the world choose their targets? So if you're managing your company to make the share price as high as possible, there's no room for a Gordon Gecko. Okay? If you're managing it as efficiently as it can be run, the share price is 22, okay? Gecko would have to pay a premium to that to get control of your company. If he can't look at it and say, if I go in and change this, this, and this, I can get the share price up. If he can't do that calculation, he has no incentive to take over the company. It's only when he says, okay, this company's selling for 22, but if I came in and changed this, this, and this, I could push its price up to 30. Now he has incentive to come in. So self-interest, as in let's avoid hostile takeovers, is in fact another reason for favoring value. In any discussion of objectives, Milton Friedman has to come into the discussion. So your semester's about to end. You should have a little bit of time available. You could do worse than reading Milton and Rose Friedman's Free to Choose for some good insights on these issues. But I just picked up a couple of quotations from Milton Friedman. The most important single central fact about a free market is that no exchange takes place unless both parties benefit. Free exchange, as opposed to coercion. The only slight modification I would make here is no exchange takes place unless both parties perceive they will benefit. Leave just a little bit of room there for, well, dishonesty in transactions is a different story. Somebody perceives they're going to benefit, but they don't actually benefit because there's been misrepresentation. That's a different story. Another good Milton Friedman quotation. Most economic fallacies derive from the tendency to assume that there's a fixed pie and that one party can gain only at the expense of another. I think Friedman's onto something here, both in the fact that it's not a fixed pie, that efficient decisions make the pie bigger, and second, that a lot of people don't seem to recognize that. When they see someone getting ahead, there's a perception that that could only have come at the expense of someone else, and it's just not true. So I would summarize the Adam Smith argument as saying that pursuit of profits in a free and competitive society is efficient at providing what society values. The market will tend to do a good job of delivering what society values. So if you get into discussions with people about pros and cons of a market-oriented, price-oriented, value-oriented economic system, you'll often find that the discussion really comes down to they think society values the wrong things. The system's delivering what society values, but people don't always approve of what society values. So I'll just take as an example the paparazzi photographs. Paparazzi chases the stars around, takes pictures of them, puts it in the newspaper. Okay? They do it because it sells newspapers. Okay? You and I may not be the ones that value it, but society values it. And of course, you recognize that we could choose much more controversial examples to illustrate this point if we wanted. The market's going to tend to deliver what society actually values, not necessarily what you or I think society should value. And I do think that that's a lot of the criticism is actually criticisms of what society values. I'll just note that the statement about what society should value is inherently subjective, and I'll just leave the question, who should decide? We should also not overlook the incentive effects of market solutions, pursuit of profits, pursuit of value. So to illustrate that, I want to tell a little story from my own background. It involved an organization called the Rosa Luxemburg Collective. So after I finished my undergraduate business degree here, I went on to do a master's up at Washington State University. And after I finished my master's, I was invited to stay there and teach for a year. Interestingly enough, by a fellow named Hal Carr, who had been on the faculty here when I was an undergraduate. But I had made some good friends during the year I was a graduate student. And one of my good friends after graduation moved into a house in Pullman, Washington that was known as the Rosa Luxemburg Collective. So my friend was no Marxist, but he did appreciate a good deal on a place to live. So for him, the Rosa Luxemburg Collective was basically there's a dozen young people that live in the house, big old house. They each have a room. They share expenses and they share the household chores, and it's a very cheap way to live. So I would periodically go to visit my friend Dave and chat with him and get to know the other people around his house. But pretty quickly it becomes clear that while most of the people are just there for an inexpensive place to live, there are in fact one or two dedicated Marxists in the house, intellectually, that is, intellectually dedicated Marxists. And they come to find out that I'm teaching in the business school. So they naturally want to have some, let's say, discussions, debates, arguments, whatever you'd like. This is okay with me. I don't mind discussing these issues, even some friendly debates. There's one fellow, I don't actually remember his name. We'll call him Bob for sake of discussion. But each time I was over there, Bob would see me. He'd want to come over and he'd want to debate. He'd want to tell me about the evils of the free market system and how a Marxist system would really be much better. Anyway, this is okay with me. We have some debates. This is all fine. After a while, I realized I haven't seen, what did I call him? Bob? I haven't seen Bob in a while. So I asked my friend Dave. I said, Dave, I haven't seen Bob in a while. What's going on? He said, yeah, we had to ask Bob to leave. And I said, why'd Bob leave? Well, he wouldn't do his share of the chores. So, the ideologically committed Marxist didn't want to do his share of the chores. Anyway, the point is there was something wrong with the incentive structure in the Rosa Luxemburg Collective. On the other hand, the profit motive is a powerful incentivizer. All right, but that was kind of the arguments in favor. There certainly are arguments, we'd say arguments against or strong cases that a system of pursuit of profits or value is not necessarily perfect. So standard textbook criticisms in the sense that these are well established in economic theory, they're in the textbooks. Cases where the profit motive does not necessarily lead to the most efficient outcomes. Okay. Externalities. You've all heard the arguments. Externalities are costs and benefits that are real to society that are not captured by the decision maker. Pollution is a classic example. Education, I think, is a classic example in the opposite direction of a positive externality. But generally speaking, if there's costs or benefits that are real that the decision maker doesn't capture, the free market doesn't necessarily get you to the very most efficient outcome. If there's information asymmetries, if there's things that one party to the transaction knows that the other party doesn't know, you can get inefficient outcomes. Either markets breaking down as just distrust keeps people from entering trades that would have been good, or people entering trades that they wouldn't have entered if they had known all the facts. A lack of well-defined property rights. Fish populations are a classic example. If somebody knows they own this fish population, they have every incentive to balance how many fish they take today against a good, healthy breeding stock and making sure that there's still fish tomorrow. If nobody has property rights, except whoever gets the fish in their boat, there's every incentive to overfish the population. It's called the tragedy of the commons in the economics literature. And then, of course, there's monopoly power. We all know what monopolists will do. They'll restrict output and raise prices, and we don't get the first best outcomes. And interestingly enough, Adam Smith is usually held up as the person who argues most forcefully in favor of markets and competition, with his phrase "invisible hand." But Smith himself was very aware of the dangers of monopoly power, and actually had this quotation that people of the same trade seldom meet together, even for merriment and diversion, but the conversation ends in a conspiracy against the public or in some contrivance to raise prices. Anyway, these are all well-established potential shortcomings. I've been a little bit moving interchangeably between profit and value, but they're not synonymous terms. So profit's a period-by-period notion. Value incorporates time. Roughly speaking, shareholder value is the present value of the stream of profits over time. So the big distinction between profit and value is that value incorporates trade-offs between today's profits and tomorrow's profits. So we can all think of ways that companies could potentially increase today's profits while undercutting tomorrow's profits, like cutting back on maintenance today or cutting back on product quality today if people can't detect that right away. So value is actually a more sophisticated and I think more desirable goal than period-by-period profit, because it involves trade-offs between today's profit and future profits. So given repeated contracting, a focus on value rather than profit is very often preferable from a general social viewpoint. But I want to also come back to the second slide, where I picked up the two quotations from the two textbooks, and one of them talked about shareholder value and one of them talked about shareholder price. Now, the two sets of authors may have been thinking about price and value as synonymous, or they may have been trying to say different things. I'm not sure. But potentially, we do get a distinction between price and value. So a company's observed market value, what you actually see, is based on prices out there in the financial markets. So companies' observed market value is price per share times the number of shares outstanding. This is where the finance theory of market efficiency becomes relevant. Okay. So most of you have been exposed to it. The theory of efficient markets in finance basically says the financial markets get the price right. The price does reflect the underlying value. So in an efficient market, price and value are synonymous. But are we sure that the markets are completely efficient? Now, when I was finishing my Ph.D. in the early 80s, it seemed like the world was sure on this one, at least the world that I was circulating in, academics teaching finance. But no longer. There's been too many counterexamples. We have to acknowledge the possibility that market prices can differ from the underlying value. So if the market's not completely efficient, market price can differ from shareholder value. But which one's easy to observe and which one's hard to observe? The market price is easy to observe. The underlying value, the present value of the cash flows, is hard to observe. So can share price differ from underlying value? It can. In particular, asymmetric information. If there's some information that's relevant to value that the investors don't have. Or if the company succeeds in distorting the information, fooling the market. Okay. One of the implications of the efficient market theories is you can't fool the market. If anybody believed that before, they don't believe it after Enron. There's just no question that Enron succeeded in fooling the financial markets, at least for a period of time. The other thing that I'd throw in there, because I don't want to put all the blame for potential inefficiencies in the financial markets on companies, investors. Assessing the true value of a company is not an easy thing. It involves all the tools that you're going to talk about in your finance courses. In particular, it involves coming up with the best possible forecasts of the company's future free cash flows, carefully picking discount rates, computing present values. It's not easy. There's shortcuts that are tempting, like price-earnings ratios. All right, price-earnings ratio in this industry is 12. Earnings are 2. 2 times 12. Price is 24. Let's hit the golf course. Except it can lead you wrong. Where did that come from? Where did you come up with the price-earnings ratio is 12? This is one of my favorite ones from a little more than a decade ago, valuing companies by a multiple of the number of web hits. It's a nice quick shortcut, but it's not very well connected with the real determinants of shareholder value, which is a sustainable stream of profits over time. Do market prices always reflect underlying value? So our graph here covers 96 to 2002. The red line is the broad stock market, the Standard & Poor's 500 index. The green line is an index of internet stock prices. Now, some people look at that and say, looks like there was a bubble in the prices of internet-oriented stocks around 1999 to 2000. Anybody see anything that looks like a bubble there? Looks kind of like a bubble to me, too. So there's still some debate. There is still some serious debate over this. Some people like to argue that there were rational reasons for that run-up in prices. But I think it's easier to tell, it's easier to interpret that price behavior as a bubble, that the markets got it wrong, that people took too many shortcuts in trying to value these securities around 1999 and 2000. All right, so the textbooks. When the textbooks say the focus should be on maximizing share price, there are a bunch of implicit assumptions in there. So what are the implicit assumptions in there? First of all, one implicit assumption is that the financial markets are efficient. The efficient markets theory holds so that the share price equals the underlying value. Second implicit assumption is that we have competitive markets. Competitive markets so that the prices are revealing society's values for the goods and services. Also, absence of important externalities, absence of important information asymmetries in the product and service markets. Given those assumptions, a particular action will be positive net present value, will enhance shareholder value only if it's also good for society. But if we're not sure about those assumptions, we can't be so sure that the prescription to manage the firm to maximize share price is desirable from the viewpoint of society as a whole. So that's one of the things I wanted to convey today, that when you read in your finance textbook that the goal is to maximize share price, that prescription rests on some assumptions. Yes?
What if markets aren't efficient? What's management going to do?
Well, my take would still be, the question is, what if financial markets are not financially efficient? My take would be focus on managing the underlying shareholder value as opposed to the share price. And I recognize that that's not as easy to implement as focus on the share price. But if the markets are getting wrong, you don't want to be chasing a wrong target, essentially.
Isn't your problem there then that if markets are not efficient, prices are not efficient, then the returns that you use to measure net present value are wrong, and your observations of net present value are then wrong, And so then what do you do to value the company?
So you got to stick to fundamentals. You got to stick with best forecasts of how much you can sell, best forecasts of the prices you're likely to be able to get in the marketplace for what you sell. You got to focus on the fundamentals and not chase what's presumably a wrong price. Do companies act to maximize shareholder value? Open question. There's a lot of other possible objectives for companies. We're not the first ones to note that, way back to Burrell and Means, I think about 100 years ago. Stock options. Stock options are a powerful motivator. If you want people to focus on share price, give them stock options. So I teach option valuation formulas like the Black-Scholes model that many of you will have also taught or seen in your classes. But something I've noticed is that when people's self-interest is involved, their intuition tends to sharpen right up. So you don't have to have seen the Black-Scholes model to know that when you own call options on a stock, the stock price going up is really, really good for you in terms of your wealth. Stock options are a powerful motivator. If you want people to focus on share price, give them stock options. They will pay attention to the share price. The question I would pose is, does it work too well? And in particular, if the financial markets might not be efficient. You've given people incentives to focus on the share price, but if the price can divulge from value, have you given them incentives to do the wrong things? I'll just bring up some examples of what happened at companies like Enron and WorldCom. All right, broadly, what can go wrong? Okay. So there's some things that increase the share price that don't necessarily increase shareholder value if the markets are not completely efficient. Okay. Second, there's some things that can increase shareholder value that don't necessarily benefit society as a whole. Monopoly power, acting to increase your monopoly power, or externalities. And third, there's some things that can benefit decision makers without necessarily increasing shareholder value. What's broadly referred to as agency problems, that the decision makers, the managers, may just do things that benefit themselves. So an example that to me kind of speaks a lot. So I had the privilege of speaking at a conference in Ho Chi Minh City a few years ago. So this is a photograph from Ho Chi Minh City. Hope you can make that out. There's a lot of motorcycles. Crossing the street in Ho Chi Minh City is an adventure. I was coached on how you do this, because the stream of motorcycles is not going to stop. You know, if you're going to wait until there's a break in the stream of motorcycles, you're going to be there till midnight. Okay. So you cross the street by walking slowly and predictably, and they go around you. You don't stop. You don't run. You walk slowly and predictably. All right, but that isn't the real point. But there's all these motorcycles. So I'm walking with a Vietnamese friend, and I'm seeing literally hundreds of thousands of motorcycles. Much of the urban population is commuting by motorcycles, including the middle class and professionals. So you see people in business suits on their little motorcycles off to work. But there's rough streets, lots of potholes and stuff, and these motorcycles are a little hard to tell in the picture. They actually have kind of small, skinny tires. They're not that much bigger than bicycle tires. So I'm thinking these small, skinny tires, potholes in the street, there's got to be a lot of flat tires. So I say to this to my friend, I say, they must have a lot of flat tires. He says, oh yeah, well see that guy over there and that guy over there? He says, they're repair people. There's repair people that come out along all the major thoroughfares, and if you have a flat tire, they'll immediately be out there to fix your tire for a small fee. And I'm thinking to myself, wow, what a wonderful example of Adam Smith's invisible hand. That there's this social need, and the market is stepping up to provide a solution to that. So I'm thinking that. But before I can even finish the thought in my head, my Vietnamese friend continues. So they're along the street. They're there to patch your tire as soon as you have a problem. And sometimes they throw nails in the road. I just thought that illustrated a lot about the good and the bad of the profit motive. All right, so let's hit kind of quickly what can go wrong, and in particular, what can go wrong if it's possible to fool the market. What can go wrong if a firm can manipulate its accounting statements and fool the market? And again, in an efficient market, that shouldn't happen, but apparently it does happen sometimes. So WorldCom, it was actually pretty simple. $11 billion in expenditures that should have been expensed were capitalized instead. Really simple, just overstate your income, overstate your assets, but it apparently fooled the market for a period of time. I'll just ask, where were the auditors and fundamental analysts? Enron. Enron was complicated. I can only touch the surface at Enron. Roughly 3 classes of problems at Enron. Just an example of one among many of inappropriate accounting that appears to have been successful at Enron. Enron entered some long-term forward contracts to deliver natural gas. It's actually a very simple contract. It's a contract that says at some date in the future we'll deliver natural gas to you and you'll deliver money to us. It's all in the future. The only thing is we've set the terms of the contract today. But everything's off in the future. That's what the contract is. But how did they book it? They booked the revenue now, even though the money doesn't come in until later. And the obligation to deliver natural gas, they just kind of forgot to report anywhere. I'm not an accounting specialist, but it just seems a little misleading, doesn't it? And it was. So Arthur Andersen approved those financial statements. Arthur Andersen was also doing a ton of consulting work for Enron. Enron executives sold tons of their shares before these frauds were uncovered at the high share prices. Dilbert's always fun for business school students, so won't spend a bunch of time there. I'll just point out that if it gets on Scott Adams' radar screen, it's probably an indication it's a real issue. I'm going to call this theft. I don't know if theft is exactly the right word, but it was an interesting episode. So Enron files for bankruptcy on December 2nd, 2001. It's a Sunday. I didn't actually realize you could file for bankruptcy on a Sunday, but it seems you can. So they filed bankruptcy on a Sunday. 2 days before, Friday, paid $100 million in bonuses to a select group of executives, in particular energy traders. The story was that they needed to pay these $100 million in bonuses to retain the talent, to protect the value of the trading operation. That was the story. Of course, within 4 weeks, they gave away the trading operation to Union Bank of Switzerland for nothing. So we wonder about that story. In any event, this went to court. The courts ultimately ordered that the money be repaid with interest. I was proud to have served on as a consultant to the legal team that got that money back. Just another example of things going wrong at Enron. So any of you live in California during summer of 2001? Remember the phrase rolling blackouts? Now, it was partly the Californians' own fault. They basically restricted additions to power generation and to the power grid for a long time. So it's actually kind of fun to conjure up images of aging hippies who spend a long day protesting against power plant construction and then go home and they're angry because there's no power to run their cappuccino machine. But it wasn't just that. So there is a shortage of capacity. The system is running right near the capacity in terms of how much electricity it can deliver, and there are periodic rolling blackouts. Enron is mainly a trading company, but they also have contracts to manage some power plants in California. So in general, insider trading is illegal, right? Now, how about insider trading when you create the event yourself? All right, so here's a taped conversation between an Enron power trader and an Enron managed power plant operator. Trader, we want you guys to get a little creative. Plant operator, okay. Trader, and come up with a reason to go down. Go down as in shut down the power plant. Okay, so we're just coming down for some maintenance, like a forced outage type of thing. Right, that's okay, that's cool. And they did. So the system's running near capacity, sudden plant outage, wholesale power prices spike. The traders had taken positions to profit from that spike in price, and meanwhile lights go out. One thing I can say is this is not what Adam Smith had in mind.
More like the nails in the road.
Yeah, more like the nails in the road. I do want to mention, though, unintended consequences. So Enron, WorldCom, they told us that it is possible to fool the financial markets, at least for a period of time. They told us that pursuit of profits in some cases is clearly not in the social interest. But there are also some unintended consequences. So the main legislative reaction was Sarbanes-Oxley, which actually has some real teeth to it. Maybe too much teeth. So CEOs and CFOs can go to prison if financial statements are imperfect. Big increase in compliance costs. It applies to publicly traded U.S. companies. Is it cause and effect? Is it coincidence? So this is the numbers of companies publicly listed on the New York Stock Exchange and the London Stock Exchange since 2001. For some reason, New York has been losing out to London since Sarbanes-Oxley. I'm not saying I know the exact right answer. I'm just saying unintended consequences are one of the factors. All right, we've only got a few minutes left, but we do need to talk about the mortgage crisis and the recent financial meltdown. So why were so many risky subprime mortgages, no-doc mortgages, approved? Why were the originators of these risky mortgages able to sell them to investment banks and other investors for high prices? In part because they received high credit ratings. Why did the subsequent defaults spread so widely and cause such large problems across the economy? Just a few insights. Incentive effects matter. Some people in this room, in years to come, will be in position to set compensation plans for their companies. Think a lot about the incentive effects of the compensation plan you set. Okay. I want to touch for a moment on something that might look like it just belongs in an option trading class. The business of selling out-of-the-money put options. Okay. So out-of-the-money put options are put options that'll only be exercised, they're options that'll only be exercised if market prices drop quite a bit. You're selling them. You get revenue now. So the business of selling out-of-the-money put options is characterized by always generates revenue now, rarely generates a loss, but could generate a big loss later. Okay. So what does this have to do with the financial? Well, one quick rhetorical question. So what if you set up a compensation plan that basically says, we're just going to pay you a percentage of the volume of put options that you sell? People are going to sell a lot of put options, right? Now, what does this have to do with the financial crisis? A point that will be made in some of your finance courses is that the business of lending, mortgage lending in particular, and risky lending secured by assets in general, is equivalent to a risk-free loan and the sale of a put option. If you just compensate people on the volume of the loans they make without taking into account the magnitude of the put option liability that they're taking on at the same time, they're going to sell a bunch of loans. They're going to respond to that incentive. But the financial crisis, it's like an onion. Every time you peel back one layer, there's just another, and each layer makes you cry. So one of the issues is why were so many really highly risky mortgage loans made? But the next question is why were people able to sell those mortgage loans in the secondary markets for high prices? I mean, the secondary markets should have provided a check on this. If there was a high rate of defaults, predictably a high rate of defaults on these loans, they should have gotten discounted in the secondary markets, and that should have put a check on the whole process. It didn't happen. Lots of these deals were rated AAA, when certainly with the benefit of hindsight and potentially in real time, we would question why they'd be rated AAA, and people paid a lot for them. Part of it was bad models. Some of you have probably seen the press coverage on this. Models that assumed housing prices could only go up, models that assumed that there was no correlation in housing prices across regions. I mean, was that really people's best assessments, or did they have incentives to use those assumptions because they were getting paid as a percentage of the deals they got done? Should ratings go unquestioned? Obviously not. If you have some more reading time, I recommend The Big Short by Michael Lewis. Very entertaining writer. You'll get some insights on this issue. Some people did recognize that these mortgage securities were overvalued. They just had no way to do anything about it. Eventually, there was introduction of derivatives whose payoffs were tied to the mortgage securities. And the press has actually criticized this fairly widely, saying that you're introducing instruments that allowed you to bet for failure, phrasing like that. I think the press is off base. I think if instruments that allowed people who recognized what was going on had been introduced sooner, then the people who recognized what was going on would have got in the market and would have imposed some market discipline sooner. So where do we stand? I'll hit this really quickly because we're almost out of time. We need people who set up compensation plans who understand finance and economics and incentives. So, business schools came in for some criticism in the wake of the financial crisis, and I suppose it's good for us to be reflective and think about what we can do better. But in my mind, if anything, the crisis tells us we need more people who understand these issues, and in particular among boards of directors, and people who are on compensation and audit committees who understand these issues and understand the incentive effects. Performance-based compensation, I still think makes a lot of sense. It's just if you're going to tie it to the share price, tie it to the long horizon share price. Not today's share price, but something like, say, a 5-year average share price. Enron shows us you can fool the market, but not forever. The market did figure it out. Government level, incentives to make markets as competitive as possible, clearly defined property rights. We do need sanctions for misbehavior. Misbehavior is going to happen. We do need sanctions for it. Educational level. What do we need? We need students who are trained in financial statement analysis to see through accounting frauds, in fundamental security evaluation, and in risk management. And I'll add to that instructors who are reflective about what it says in Chapter 1 of the finance textbooks. What are the assumptions that underlie this recommendation to maximize value?
What does that mean, to be reflective?
Reason through, have a discussion of the pros and cons. I think that in this day and age, to just say the goal is always to maximize the share price is too simple, and I don't think that we want to tell our students that, look, your goal is maximize the share price. Doesn't matter how you do it, just maximize the share price. I think that gives you an Enron situation.
Assuming honesty, obeying the law, what's wrong with the goal of maximizing present value?
Let me jump to my conclusion because I think that's exactly where you want to go, and we're just about out of time. So I'm going to skip the Goldman resignation, other than to note that if the guy who resigned is correct, then he's on to something. Is he correct? I don't know. All right. So here's my bottom line: the pursuit of shareholder value by providing goods and services that society values more than the cost of what you're producing is both efficient and honorable. So despite all these imperfections, I don't think we want to throw out the baby with the bath. Okay? So there's one prominent public figure who I won't mention by name, but she may or may not be married to the current president, who made a speech a few years ago and said basically you need to choose whether you're going to do something to serve society or work in the for-profit sector. She was wrong. There's tons of room to do things for society in the for-profit sector, precisely because when it's done right, you're delivering goods and services that society values while seeking profits. On the other hand, the pursuit of shareholder value or personal wealth through restraints on competition, disseminating false or misleading information, or violating others' property rights is not efficient or honorable. Short version, pursue shareholder value, but do so honestly by meeting customers' needs and wants. That's my version. So I would say managing to increase the share price does make sense when it's subject to some simple checks, such as ultimately, I don't think it's complicated. There's nothing wrong with pursuing shareholder value as long as it's done the old-fashioned way. You're creating value by fulfilling customer needs and wants, and doing it honestly while remembering there is a difference between right and wrong. That's my punchline.
Thank you, Gecko. Will you take some questions?
Certainly.
Okay, there may be some of you that need to go to a class, and that's fine, but Hank's offered to stay and answer.